Hi everyone, welcome. I'm Ross, the chairman at the Hive Business Group. Really pleased to welcome Simon, our Chartered Tax Director here today. Welcome, Simon.
Thanks, Ross. Hi, everyone.
Great. Well, we are here to talk about inheritance tax and some really important kind of planning elements. There has been a huge amount kind of mooted about inheritance tax recently, including kind of massive changes to the pension regime. Why are we here kind of today with an update, Simon?
Yeah, well, absolutely. There's been a lot. You'll have seen a lot in the news over the last year since we've had the kind of Labour government in situ. But the most recent update is actually probably summarize it by saying no kind of new news other than we've taken that step closer towards it becoming law. So everything that was
Okay.
announced in the budget earlier is now in what we call a finance bill, which is the
Yeah.
step before it becomes law. So it's coming basically.
Okay, so there's this kind of huge amount of advance warning, shall we kind of call it, where they tell us what they're going to do, and now we're in the motions of it actually becoming a law. Is that right?
Yeah, these things start with kind of headline announcements in a budget, which you'll all have seen on the telly, and then you get months of it being in the news and people up in arms about it. And then we get some detail in draft law as to actually how this is going to be implemented and actually whether there's more to it than they announced or less to it than they announced, or a famous kind of U-turn might have happened. But
Yeah.
actually in this case, we're treading the path that was outlined.
Great. Okay. Would it be okay if we kind of bring it right back to basics? What is inheritance tax? How much does it kind of levy? Who's it go to?
Yeah, good question. So inheritance tax is tax that, well, I say everybody, but the tax that in theory people pay on their estate when you pass away. So it's based off of the value of the assets in your estate, 40% tax rate, but there's some exemptions. And part of what the changes are some erosion of some of those exemptions. So previously, business and agricultural property, farms, shares in your company, your dental practice, that kind of thing have all been exempt, and everyone has a £325,000 naught rate band where you're not paying any inheritance tax. But above
Yeah,
that, it's kind of a 40% tax. Bit of extra allowance there for your family home, actually, but
not much.
not much. Not given
No. Okay.
the you know rates that were set decades ago and decades of rising house prices in the meantime means we're edging ever closer to more people being caught by this.
Well, I hate to kind of put things in a box, but if we've got a husband and wife situation with that kind of enhanced allowance you're talking about, the £1 million kind of family home, assuming no mortgage, that's it. That's your kind of your inheritance tax free band
Yep.
resolved, isn't it? So
Yep.
we've definitely got kind of, I mean, government policy is essentially a huge amount of kind of fiscal drag, really. So they, as you said, they kept those rates the same for ages. Property price increases have happened relentlessly over time, over the kind of medium to long term. So it's not a ridiculous situation that most people's inheritance tax free banding is taken up by their family home. So anything else they own on death is going to be subject to inheritance tax. Is that too sweeping?
No, that's pretty much it. With the I suppose the caveat is that some business property will remain covered by exemptions.
Yeah.
But again, we're in a world of increasing business values as well, so those are quite quickly going to be swallowed up. A lot of what you'd have seen in the news over the last year is farmers worrying about the value of the land their farm consists of.
Yeah, well, I mean, 40% is pretty painful and it hurts and it's taxed on top of wealth that you accumulated from your taxed earnings. So,
Hmm.
I'm sure there'll be supporters for it or against it. But those are the kind of the dynamics that
Yeah,
we're dealing with. So, if you've got a retirement pot full of cash, if you've got a retirement pot full of stocks and shares, if you've got cryptocurrency that you're holding, if you're holding any other kind of huge range of assets, and now your pension pot as well, it's
yeah,
all in that bucket where they're going to try and put their spade into it. Is that right?
yep, that's it.
Okay, so The pension thing is probably a little bit of a focus point for what we want to talk about then. So as you're alluding to there, we've now got a whole load more kind of details that surround it. I think I'm getting from your kind of vibe there, nothing's changed from what they were originally telling us. So the pension or the remaining size of your pension pot in your estate on death is taxable. Have there been any changes to it, or was that it?
No, that's it. So it hasn't happened yet, but from the 5th of April 26, undrawn pension benefits are now counted in your estate for inheritance tax purposes.
And is that like a light switch then? So it just kind of the day before you're fine, so to speak. Um, no inheritance tax charge on death. Day after, 40%.
Yep. Yep.
Cracking. Well, there we go. I think there's probably a huge amount of kind of spectators looking at it going, oh my God, like, what do I do about it? Um, and I really think, I mean, it's not as if inheritance tax wasn't motivating enough for people to try and take action about before, but we've been subject to this kind of massive inflation increase.
Mm.
So the wealth position for the average person has increased more. So this has suddenly become of way more importance for a huge number of people who kind of weren't, perhaps don't have it in their kind of field of vision or haven't had it in their field of vision until now. And now it's, like a massive problem. What's the roadmap to kind of sorting it?
Well, I think the roadmap to sorting it is kind of turn up to the start line, actually. We need to know the size of the problem you've got. So, like you say, we've probably had years of it being the one tax you can almost choose not to pay by being a bit proactive. A lot of government policy has been about driving contributions into pensions. There's been a lot of tax relief for that to happen.
Yeah.
That's meant we now have, large pension pots in the medical sector. They're now caught by inheritance tax. They weren't before, and people are going to have to get used to the fact that there is that exposure now. There might not
Mm,
be ultimately a charge because there are still some things you can do about it, but we need to know what is in the estate, what assets and liabilities does an individual have, and what inheritance tax charge might there be if the worst case were to happen tomorrow.
mm. I mean, can you just ostrich it and ignore it? Like doing nothing is an
Do,
option,
doing
isn't it?
doing nothing is always an option. You can do nothing about this, but you will be leaving significantly less assets to your descendants than if you perhaps take some steps to mitigate what the tax might be.
Yeah, so the pension things, and sorry for kind of veering off into the kind of the negative part of it, but we said that the family home may well erode the entire tax-free position. It's not unknown then that someone will build up sort of a 500, maybe £1 million pension pot, and let's say they don't do anything, and they spend what they need to spend, but that pension pot is there. What happens with the tax on that pension pot? Like, is it as simplistic as 400 grand on that £1 million pension pot?
It's actually worse than that. So, firstly, I would say NHS superannuation pensions are not caught by this because, of course, they don't get passed on, so they're not taxed as a death part of the estate on death. But actually, the pension at death will need to be the tax will firstly need to be paid by the executors of the estate. So the people looking after the estate, not the pension fund itself, will pay the inheritance tax on it. And then there can actually be kind of further income tax charges as though the recipient of what's left is drawing down that pension and paying their own income tax on it. So
Okay.
there's a double whammy there.
Well, okay. What should people do? Like, I think usually an advocate of plan as early as possible. We now got a much kind of more
Mm.
solid realization this is coming into law. You were saying earlier, firstly, kind of take your head out of the sand to a certain extent.
Yeah. Yeah, first step, we can help do an assessment of your inheritance tax position. Like I said, list of assets, list of liabilities, bit of an idea as to perhaps what maybe your will says. We can help to predict inheritance tax exposure. Next best thing, next step, once we know the size of it, I think there's never been more important that you're undertaking proper financial planning. And that means when I say proper financial planning, I mean involving a financial advisor to help plan. And I don't mean making sure you've got the right pension or making sure you're invested in the right stocks and shares fund, but actually carrying out the plan. What assets are there? How are they likely to grow? What are your requirements for cash likely to be? Do the books balance, I suppose.
Well, it's not unusual these days to have there's almost this kind of traditional cliff edge retirement date is becoming a bit more kind of obsolete. So there'll be moving parts, won't there? There might be a pension pot, there might be some other assets, there might still be rental income, let's say,
Hmm.
presumably on which the properties are going to be taxed at 40% size, is that
Yeah,
right?
yeah,
Yeah, so you've got all these kind of moving parts. It's not as simple as I need X million pounds by then, and then I'll just spend it through time to make sure I got enough. There might still be kind of income and profitability poured into the wealth position.
yeah. I mean, you'd hope that assets are generating income and growing in value anyway. We build these assets for this reason, so there's a lot of moving parts, and it's about actually making sure they're going to stack up at the end and seeing what can we control from there. So I think actually there's going to be a big shift in kind of financial plans for people. So historically, like I said, a lot of government policy has been money into pension, lock that away.
We have still got a an apparent pension crisis though as well, as in
Yep.
the average person is underfunded in their pension for retirement age. So
Yeah.
I mean, it's probably a story for another day. But
Yeah.
what on earth
Yeah.
they're going to do with this kind of contradiction?
No, I don't know, and that is always going to linger. But I think, like I say, we've seen this flip now in actually there are still benefits to pensions, certainly tax benefits to contributing to a pension, but the asset that we now have control over what might happen to it is perhaps no longer the pension, and we can look at, well, what assets are left over outside of that pension pot? What can we do with those instead? With the plan being to spend the pension rather than leave the pension as the tax-free asset to pass on.
Okay, so you still think, and we kind of cut quite carefully, there may be some merit to continuing pension contributions and filling up your pension pot, ironically.
We live in a world of high income tax rates. Pension contributions still attract really good tax deductions. So although we don't know perhaps the end game there, we know that actually funding a pension is very tax efficient at the moment because tax rates are so high.
Yeah.
So yeah, I think so.
Yeah, and probably be a huge amount of a case of horses for courses to a certain extent. That no single rule, which kind of comes back to what you're saying. The financial planning advice is kind of key. And I know for a fact that more than ever, you're kind of dovetailing your own kind of tax advice with the pension and the financial planning advice. So can't have people working in silos anymore in your advice team.
No, definitely not. Not least because kind of legally we can only do part of it. We cannot give pensions advice. I can't tell you you should have a pension. I can tell you there's a tax advantage to building a pension, but it's working with your financial advisor that we can kind of see the whole picture and get the best outcomes.
Or vice versa. The financial advisor we work with uses us a huge amount of the time to kind of
Hmm.
provide the complementary advice because what you're saying there is suddenly we've kind of flicked the switch and we're now into a scenario where the pensions may well be planned to be spent, and you're looking at your other kind of asset portfolio and looking at how that is best structured
Yeah,
to kind of mitigate the inheritance tax problem, which is like it's just a massive U-turn in terms of
yeah,
concept planning.
yeah, absolutely.
What type of stuff would people have now? So let's say, and this is really generic, not financial advice, but we've got a pension pot. We are now planning to spend that at retirement, so we will draw that down to make sure the government doesn't get their 40% tax. What about the kind of the pot of cash, stocks and shares, ISA, cryptocurrency, classic car, whatever,
Yeah.
it might be.
Well, I suppose at its most basic level, it's about not having those assets owned anymore. So giving them away basically to the children, if you have children, other family members perhaps, but any assets that are yours are going to be caught by inheritance tax rules. So
So are you saying give them away?
no answer fits everyone, but possibly
Okay.
yes. Giving things away is a way to start to reduce the size of your estate. So giving certain things away starts a clock. So
Yeah.
any assets given away 7 years before death are outside of inheritance tax. So that might mean there's a portfolio of rental properties, for example, that okay, I don't really need to benefit from the income of these anymore. I'm going
Yeah.
to be spending my pension instead. So let's,
Yeah.
maybe liquidate these into cash and give that to the children. Maybe let's just
Yeah.
give the pot of shares, sorry, the pot of properties themselves to the kids.
Yeah.
It'll be very bespoke depending on what assets each individual has,
Yeah. And watch out for other taxes.
and watch out for other taxes. Yeah, and again, this is where the kind of the financial plan comes into it to know, okay, perhaps we want to plan to spend all the pension, but is that enough? Is there anything else we need to hang on to?
Yeah.
What's left that perhaps we can give away?
Yeah. Well, and I know you're also doing kind of a huge amount of work on planning for the wealth accumulation 10, even 20 years kind of ahead of time, aren't you?
Yeah, yeah. So I think this is kind of there's no end to it.
What's what's the kind of the essence of the family investment company structure?
Family investment companies, I think they come under the banner of we're giving assets away. So maybe in a not quite so blunt as that, but a family investment company is broadly a company where the parents, perhaps not just the parents, but the parents keep control of everything. So you're in charge of all the assets and what happens with them and how they're managed and whether the company still owns them or not. But fundamentally, it's a company which is owned, at least in part, by children.
Okay.
They can work kind of really well where there is future growth planned. So
Yeah.
the parents kind of contribute the initial assets to the company. It might be an existing company already, but the children have some shares and future value is accumulating outside of the parents' estate. But
Yeah,
the
okay.
parents are still
So
in charge of everything.
yeah, kind of control of it, but
Yeah,
it's never you don't have to give the stuff away because if set up at the right time, it's never theirs to start with.
yeah, yeah. Future value is what you're
Yeah.
passing there. In some circumstances, there's other circumstances where you actually will give them all away, but still retain control of them if
Yeah.
they're things you want to make sure remain in the family, for example.
Massive demand for it is more complicated, isn't it?
It is more complicated, and there's kind of ongoing admin with it. A company's going to exist in perpetuity, probably. There's lots of kind of taxes to watch out for on the way in, maybe
Yeah.
taxes on the way out, but we're looking
Yeah.
to avoid that 40% as we go.
Well, like I say, you can
Um,
always do nothing and pay HMRC £400,000 for every £1 million that you've worked hard to accumulate.
yeah, yeah,
Um, I mean, I was going to say this is tongue in cheek. It's kind of becoming really not tongue in cheek, but there's a massive amount of kind of sentiment and conversation that I'm seeing um, about kind of moving jurisdiction. So, kind of the classic example, and there are a few jurisdictions out there, but classic example is move to Dubai. It's nice and warm, and they won't tax you as hard as UK HMRC.
yeah.
I'm sure I'm oversimplifying it again. So is this valid? Is it?
It is valid, but yeah, that is a very simple version of it. So broadly speaking, inheritance tax, you only pay inheritance tax if you're resident in the UK. So if you're tax resident here, you pay inheritance tax on your worldwide assets. If you're
Yeah.
not resident here, you only pay UK inheritance tax on assets physically located in the UK. So if you have property here, land and buildings,
Yeah.
they're still going to be within the scope of UK inheritance tax.
Yeah.
But otherwise, if you're overseas, well, you follow their rules broadly.
Yeah.
So there are countries that don't have the same taxes as us. So inheritance tax is not a thing.
I mean, it becomes more and more compelling, really, doesn't it? But got to be quite careful as well.
You do have to be careful because actually there can be taxes caused by making it happen in the first place, believe it or not, and it can very easily be undone by, coming back to the UK a few too many days in a year, and all of a sudden, actually, your resident this year will have your inheritance tax, please.
Yeah, I mean, and it's like we know that extremely wealthy people do choose their country of residence, and they are very careful about the specific rules that might well scupper them. There's enough tax cases where they essentially kind of stuff things up. I think probably more my point is that the kind of the hurdle, the bar is being lowered to catch more people, so that more people are considering
Yeah.
these kind of tactics. And it's not as if every country's like this, is it? It's like it's only a small number um, that are even kind of viable for it. Most other countries have inheritance tax.
Yeah, I think the list is very small of countries where there's no inheritance taxes. I think there's a slightly longer list of countries where you might go for a limited period of time, 5, 6, 7 years, to benefit other taxes, but
Okay.
but they might not necessarily be the same countries that don't have inheritance tax.
Yeah, okay. Well, I mean, an absolute minefield, but you know, we can't not highlight it, I suppose.
Yeah,
Like, and if this wasn't kind of bad enough already, so you were saying at the top of the show that we now have some solidity about the pension change from the recent, was it budget or statement earlier in the
yeah,
year?
yeah.
What else have we got coming?
We've got another budget in the autumn, so we don't know the exact date yet, but late October, early November, there'll be another budget, and we're already hearing rumours as to what that might include. You've
Yeah,
probably
really
seen,
good news. Really good news.
yeah,
They're going to tell us, is it?
yeah, no. Well, it might be one of those where they're setting us up for something that's perhaps perceived as not quite as bad as we think it might be, but it sounds like more tax rises are on the way. There's a 40 billion pound gap in the country's finances that
Yeah,
it seems is going to have to be plugged by taxes. So inheritance tax is back on the cards,
more.
and it was actually a big kind of part of the election manifestos last year was reform to inheritance tax, and we had some changes which we've kind of just covered, but there's more changes being mooted, whether that's a cap on how much you can give away tax free, whether that's a change to how the 7 year rule works. So what we
Yeah,
haven't said is that kind of is a bit of a sliding scale. It tapers over the 7 years. There's talk of changing that. We won't know until the budget, but it sounds like it's certainly not getting any better.
more of a bit of a land grab then.
Yep,
Mm.
yep.
So don't own anything.
Yeah, yeah, that's the way through it.
Excellent. Well, really not nice to kind of hear about and talk about, but huge amount of value in being aware of it and planning as ahead as much as you can, maybe even kind of a decade or two ahead of where you need to. Is that the general guide?
Yeah, I think so. We're talking about assets that are going to grow in value over time. The smaller they are when we start to give them away, the easier the problem is to solve.
Cracking. Well, yeah, in the middle there, you've offered kind of a free initial assessment of the size of the problem. So I think uh, you know, t- take some action, get in touch, and the Hive group will help you out as much as we possibly can.
Yeah, absolutely. Would love to.
Thank you all. Cheers.
Thanks.